I don't think the correction is over. I don't even think we've started it yet. When you look to the Russell 2000, it is currently trading at close to 40% above its 200-day moving average. It really didn't get any lower than 30% above. Looking at the PE ratio on the S&P 500, we are back to about 40% above its long-term average. We really didn't get much below 35% or so. So if the decline that we got is all we're going to see, then at best I would call it a hiccup or a pullback, but certainly not a correction, which is what I define as 10 to 20%. And I will say, yes, I believe it'll happen. But anytime soon, I think that because there are more and more strategists who are calling for a correction, usually the market tries to embarrass the greatest number of people at any one time. So I would say that we'll probably end up with a correction that starts later than most people are anticipating. And it's likely because the stimulus package, which might not end up being 1.9 trillion, but could end up being closer to 1.5 trillion, still something very strong, could end up delaying when this correction occurs because we're going to have new money pumped into the marketplace. Interest rates are likely to remain low for the near term. And also, there's just not a great number of attractive alternatives for investors to put their money into. So I would tend to say that this will help continue to support the stock market over the near term. 1 week out of 4 is not necessarily a perfect indication of what the whole month is going to happen. We were in positive territory in January up until the last couple of days, and then we were off 1.1% for the full month. So I would say that there is still a possibility that we could end up being weaker in February. I mentioned the frequency with which the market tends to decline and what the average price change is to help investors to realize that there could be some bumpiness along the way. But for those investors with long-term time horizons, use it not as a reason to sell, but think about looking for those stocks to purchase that you might have missed out on before. A few months back, we upgraded the energy sector from underweight to market weight. We did not take the additional step of going overweight because we felt that a rise in oil prices would actually increase the supply and therefore start to put a lid on energy prices. I think that the increase in prices recently has been the expectation that the global economy will be opening up once again, and that could put upward price pressure on oil. However, not for the long term, because with the emphasis of going green, with the shutting down of the Keystone pipeline, XL, et cetera, that is actually sending the signal that the emphasis will be on green energy and attempting to phase out fossil fuels. Well, I think that we're seeing that the expectation of this stimulus package and the likelihood that it will come in around 1.5 trillion has been supporting GDP growth because most economists realize that the first quarter was projected to be fairly weak and that we will see a ramp up as we move into the second half of the year. For the full year, our expectation is for GDP to be close to 5%. As compared with the about 3.5% decline that we are likely to have seen in 2020. So I think that with this stimulus package, much of which is likely already factored into economic forecasts, we will see an acceleration of GDP growth as the year progresses.